If you manage to outperform markets, you still won't get rich quick and you still won't be able to quit your job tomorrow. But that's also not the point. My name is Philip. I've been outperforming the stock market for the past 4 years. I'm not trying to get rich quick. I'm not trying to quit my job tomorrow. I make a decent amount of money outperforming the stock market. And in the end, just no one absolutely cares. If you want to outperform the market, there is a first very important distinction which you have to make. At the top of everything, obviously, you have your trading capital, which is basically just all of the money which you can use for the stock market, for trading, for investing, all of the money which you have available for that. So in this case, you have 100% of your capital at the top. And for the sake of this video, let's say that this actually equals 100K. And what you're doing with the money, obviously, you don't use, and this is the first thing which will blow your mind, you actually don't use all of the trading capital for trading. But before you do anything, you just take approximately 50 to 80% of the trading capital and not trade with it at all. What do you do instead? You take these 50 to 80% and put it into so-called LTIs. And this is nothing special. It's basically just long-term investments. Yes, you heard me right. You're not using the 100% of your trading capital for trades, but you take some of it and put it into long-term investments. I will go over the why in just a second, but when it comes to the long-term investments, then you can do it very, very simple and just, for example, buy the SPY, which is the ETF of the S&P 500, or if you're a little more sophisticated and you also already want to outperform the markets with the long-term investments, what you can do is that you can also diversify your long-term investments and, for example, add gold or crypto or any other metal basically. This is also what we have been doing with elite traders and investors recently. Just after gold broke out of this $2,000 massive resistance, we substantially increased our long-term investments into gold, and therefore we have been able to outperform the markets recently just with our long-term investments. But that's not the topic of this video. I want to go over your trading. Since you're putting 50 to 80% in long-term investments, you do have another 20% to 50% which you then actually have left for your trading. And to make it concrete, let's say that for the sake of this video, you use 60K for long-term investments, and therefore you have 40K left for trade. So I will just put a simple T right here. Now, before you actually start trading, the first thing which you have to do is you have to have a trading strategy, which I will just call TS. And trading strategy is not only about where do I buy, why do I buy, how do I buy, but it's also about psychology, it's about risk management, it's about managing the individual position once you're in a trade. This is all part of your trading strategy. And before you start trading, you have to have a proper trading strategy in place, which allows you to catch setups which I share every single week in the free elite trading community. Once you actually have this trading strategy in place, then you think in your brain of a fixed number of open trades which you want to have at the same time. For example, what you can do is that you say, well, I have an 80% win rate approximately, so I want to have a maximum of 10 open trades at any given time. This is the second thing which you have to do. It's just a number which you have to come up with looking at your win rate and your average risk to reward ratio. For me personally, it's exactly that, 10 open trades, which I do have at the same time. And then what you do, you divide the number, in this case 40K, which obviously equals 40% of our entire trading capital. You take that number 40K and divide it by 10. Why? Because this is how we figure out the risk on any given trade. So we have 40 divided basically by 10, and we do have 4%. And in this case, this is also equal to 4K. And this means that with our risk management strategy, we are risking approximately, or exactly basically, $4,000, euros, whatever you're trading with on any given trade. This is the third thing which you have to do, and then you basically covered all of the three. You have a trading strategy, you know the maximum amount of trades which you have open at the same time, and you know what you're risking on any given trade. Now, why is this superior to anything else? First of all, the one person who actually manages capital well will survive every drawdown and capitalize on every rally. And that's basically what we want to do. If the stock market, just for clarification, drops, this is the stock market, we, with our portfolio, want to drop less. So this is our trading account. And obviously, if the stock market then actually rises, we, with our trading account, want to capitalize over proportionally. So the stock market rises, for example, 10%. What we want to do is we want to make 15%. If the stock market drops 10%, we only want to lose 7%. And this is how we consistently, over time, are able to outperform the stock market. Let's go through 3 examples to clarify everything. Example number 1, the stock market rises 15%. Pretty simple what we do with our long-term investments, which we have right here. Since our long-term investments are, let's go back to this example, 60% of our trading capital. The stock market rises 15%. With our long-term investments, we will make 9%. Because it's 60% of our entire capital, stock market rises 15%, therefore we're making 9% with our long-term investments. With our trades, if we do have a good stock market year, and especially also with the strategy which I'm using and which I'm sharing every single week in the free elite trading community, if we actually do have a good stock market year, and I would consider 15% to really be a good stock market year, we have a win rate of approximately 80%. Which basically means that out of the 10 trades, we have 8 winners and 2 L's. And since if you're only trading with a 1-to-1 risk to reward ratio, you're making 4% on a win and you're losing 4% on a loss, you do have a net of 6 wins, because 8 minus 2 is 6 wins, and you're making 4% on basically any given trade. You're multiplying this by 4%, and this means that with your trades you make 24%. And now we simply add the 9% which we have from our long-term investments to the 24%, and this means that you have an overall gain of 33%, while the stock market is only, take it with a grain of salt, only making 15%, you're making 33%, which is more than double of what the stock market is doing. This is how we can overproportionally capitalize during bull runs, during good stock market years. But the only thing which we can manage as traders is our risk on any given, this should be trade, not grade, obviously, on any given trade. So we always also have to look at the downside. So with example number 2, I want to give you a rather bad stock market year. Let's say that the stock market does 0%. So nothing, which doesn't happen very often. We do have either super green years or we do have crazy corrections like we're seeing at the moment. So I will also go over a crazy correction example in just a minute. But with our long-term investments, since we're just tracking the stock market, we are making 0%. Let's say 0%. Obviously, this means that some stocks are moving towards the upside, some stocks are moving towards the downside. We do have a win rate not of 80% anymore, since not everything is moving towards the upside, but we only have a win rate of 60%. And this means that out of these 10 trades, we do have 6 wins. We do have 4 losses. So we do have a net of 2 wins. And since we're making 4% on any win, just trading with a 1-to-1 risk to reward ratio, obviously, if you're more advanced, you can use higher risk to reward ratios. We're making 2 wins times 4%, means that we're making 8%, while the stock market is doing absolutely nothing. So also right here, if we do have a flat stock market year, which again doesn't happen very often, we are still able to outperform the stock market. This is where things get super interesting. With example number 3, I want to give you a very bad stock market year, which we have been seeing over the past 3 months, significant correction of 20%. I have not been losing that much, and here is why. With example number 3, let's assume that the stock market is doing a minus 20% drop, which obviously is quite substantial, but here is where proper risk management and this strategy plays its magic. We have minus 20% with the overall stock market. Our long-term investments are 60% of that, so we're losing approximately 12% with our long-term investments. 12% right here. And now this is where things get very interesting with our trades. If we do have a very bad stock market year, obviously not everything drops, but we will also have break-evens and we will also still have a couple of wins. So let's say very, very bad, worst case scenario, we only have a win rate of 40%. Now this means that out of our 10 trades, we do have only 4 wins and we do have 6 Ls, which equals a total of 2 Ls. And since we are losing 4% with a 1-to-1 risk to reward ratio on any given trade, we multiply this times 4%, we are losing minus 8% with our trades. And now if you calculate, well, we lost minus 8% right here, we lost minus 12% right here, this equals minus 20%. And now you might say, well, stock market does minus 20%, you're doing minus 20%, what's the thing? First of all, we do have a positive outcome overall because minus 20% stock market years are overall the exception. So if the stock market drops, we are losing as much as the stock market. But if the stock market rises, and if we quickly go back to the example number 1, if the stock market rises, we're making more than twice of what the stock market is actually doing, which is just an overall extremely profitable risk to reward ratio. And the second thing, just remember that I was only calculating with a 1-to-1 risk to reward ratio. Now what happened during the recent bear market, stock market was dropping minus 20% and I had 5 open trades at that time. 2 of these trades actually stopped out. So I had a stop out on TMO. Now to share with you some insights, I had a stop out on TMO and I had a stop out on ASML. Those were 2 trades which I lost. Okay, well, fair enough, you can't win every trade, especially during a stock market correction. However, I had also 1 winning trade, which was on Coca-Cola. If you look at the stock chart of Coca-Cola, just has been rallying recently. And I had a 1-to-2 risk to reward ratio on Coca-Cola. So with the 1 Coca-Cola trade, I was able to make up for the loss of TMO and for the loss of ASML. So those were overall break even. And now I'm in 2 open trades. For those of you who are elite traders or elite traders and investors, you know what I'm in. I do have these 2 open trades and they are currently sitting at break even. They moved a little bit into drawdown, but with the recent kind of short-term recovery, they are back to break even. So if I were to close out everything now, stock market lost 15% from the previous all-time high, and I'm basically sitting at break even because the 1 trade on Coca-Cola covered the 2 losses on TMO and ASML, and the other 2 trades which I'm in are currently sitting at break even. That's the beauty of basically following these rules. If you manage to actually follow what I just shared with you, you will outperform 99% of hedge funds, 99% of traders, and you are able to consistently outperform the stock market. Just to give you some context what this actually means over a long enough time horizon, you will see that instead of making the average 8% right here, if you're starting with 100K, you will have approximately 221K, which is a double over the time period of 10 years by just investing basically into long-term investments into the SPY, which has an average rate of return of 8%. Now, if you just have 1 more profitable trade, just with a 1-to-1 risk to reward ratio, then you have losing trades. Voila, this immediately changes, and now you're still having 100K, but you're making 12% over 10 years. You're actually left with 50% more. Instead, let me zoom out again. Instead of having 221K, you now have 330K by just having 1 profitable trade a year. Obviously, we can even scale this more because now if we're looking at the next 20 years and you just take long-term investments with 8%, you will have a decent $500,000, which is nice, but again, you're just moving like the stock market. However, if you now have just one profitable trade every single year, you will have 12% every single year, and you will end up with $1 million, which is double, 100%, 500K more than what you have if you just invested into the stock market. And the beauty of that is that it doesn't take 10 hours every single day of chart work. All I'm literally doing is 10 minutes every single weekend, and I analyze all of my stocks, I manage the trades, and during the week, I don't have to do anything. That's the beauty. But also right here, I'm still calculating quite conservatively, because if we just go back to example number 1, if we do have a phenomenal stock market year, and I'm overall, as always, super bullish regarding stocks, we are not even making just 4% more, but we have the possibility to make double of what the stock market is doing during that year. I know this sounds a little bit confusing, and it's definitely a lot in the beginning, but we can certainly help you with any uncertainties here at Basic Trading. The first thing which you can immediately do is click the first link in the description and join the free elite trading community. And if you then actually want to elevate your trading to the next level, you can become either an elite trader or even an elite trader and investor. Therefore, if you have not been able to consistently outperform the stock market, just follow this still quite simple framework. And with that being said, I hope this was valuable to you. I'll see you in the free elite trading community. And in the end, just remember to keep your long-term vision.